Hi everybody, welcome back to Cup of Joe. Today we're going to talk about the yield curve. What the yield curve represents is the amount of interest the government's willing to pay for the amount of time that money is borrowed. Typically, a yield curve, when it is normally shaped, is not inverted. So the shorter term the debt, the lower the interest rate. The longer term the debt, the higher the interest rate. In a healthy market environment, typically, the yield curve looks like this. The current yield curve is what we would call inverted. What an inverted yield curve means is they are now paying higher interest rates for shorter term debts than they are for certain longer term debts. Historically, a yield curve inversion is an indicator of a future recession. What this means, why this happens, we're here to explain. So, the shorter term debt is now worth more because they anticipate interest rates staying higher in the short term than they do 2 to 5 years out from now. Effectively, what the Federal Reserve is doing is making short-term debt more expensive to cool off the economy. If you've paid attention to anything that the head of the Federal Reserve has said, Jerome Powell, he basically says that the economy has to cool down to also bring inflation down. The only way to cool the economy and bring inflation down in their tool set is to raise interest rates. Historically, in an inverted yield curve environment, it's time to take risk off the table, it's time to buy short-term treasuries, and it's time to make sure that you have positions in cash to ensure that your income can be safe from the market volatility that we're more than likely to experience. So this is how an inverted yield curve can affect your portfolio, the growth side of your portfolio. If the market does correct due to the yield curve inversion, will most likely suffer losses. Therefore, it's definitely important to talk to your advisor, talk to your financial professional about how can we protect money from a future market correction. How can we make sure that I can get the return we need in a down or volatile market situation? As always, we're happy to have that conversation with you. So feel free to leave a comment, subscribe, or send us an email with any thoughts or questions you have on the subject matter or anything you want us to cover in this segment.